Boom, and we are live. Welcome to the latest episode of the ASX Small Cap Wrap. Today, it's me, Claude Walker, and also a super guest star, my friend and investing legend, Andrew Page from strawman.com.
Super guest star, investing legend. I love it. We're off to a great start.
Famous for rants on the subject of Bitcoin and property prices.
One out of two has been correct.
None is planned, but we're gonna, if we get Pat will be editing this. So Pat, if we do get a property rant or Bitcoin rant from him, let's leave it in. Some love it, some hate it, but it's just,
haters gonna hate. Haters gonna hate, man.
Yeah,
and I'm
some
used to it.
Like it the most of all. I feel like it's solidarity and anger anyway. But before we get completely sidetracked, I guess I should read out the wonderful disclaimer, which I know is everybody's favorite. So first of all, we could own shares, and of course we'll try and say so, but we could own shares in any of the stuff we mentioned. We won't trade shares. You're happy for this, Andrew? No trading shares for 2 days either way of any mention and publication of this podcast, which is recorded 26th of May, but I'm hoping that it'll be published tomorrow on the 27th. This is definitely not intended to form the basis of an investment decision. None of this is recommendations. Any statements that are advice under the law are general advice only, and your individual personal situations cannot and have not been considered. Of course, again, none of this intended as advice, but if the law did decree it to be advice, then that advice would be authorised by myself, Claude Walker, AR1297632, authorised representative, Ethical Investment Advisors, Proprietary Limited, AFSL 343937. So, with that out of the way, nice. We are going to start with one of my favourite activities, which is to listen to you take a victory lap on Catapult International.
That's one of your favourite activities. Okay. I wish I could deliver more, give you more opportunities to partake on that, but sadly there aren't.
Do you know why, as a general rule, your victory laps are so fun for me? Is because most of the time I've made money out of it as well. However, Catapult I have not, okay? So this is all Andrew, none of me, an absolute victory for Andrew's style of investing over my style of investing. Similar, but slightly different. We can explore that after we've heard the victory lap. But please, look, for the serious analysis, you can head to the website. Our friend Growth Gauge has published the FY 2025 results write-up for Catapult International Group. I recommend you check it out. However, but for the podcast, Andrew, take it away. Give us the latest on Catapult International. Also, I almost said it sometimes. Because we bought them around the same time, right? I bought Catapult at 52 cents with you, right?
Yeah.
However, unlike you, I chickened out halfway. You did not chicken out halfway. You sat there with me. We bought Pro Medicus at 89 cents. We bought Catapult at 52 cents all those years ago. Tell us the story. How did you do it? It's $5 something today. That's a 10 bag. You told everyone on Twitter that you had a spiffy pop the other day, i.e. it went up the price you bought it for like in one day, right? So
I love
tell us the story. Like now that you've been through it all, what did it feel like? How'd you do it? And how are you thinking about it now?
Massive laziness and stubbornness were a factor in there.
I'll just be honest. Back to the beginning. What did you like about it in the first place? And then how on earth did you have the guts to hold through all of the disappointments?
Well, okay. So you got to, 10 years ago seems like such a long time, and it was. So that spiffy pop, yes, I'll celebrate that. But it was almost 10 years in the making. And after buying it in the 50s, it went to $4, and then it went back to 50, and then it went to $2 something, and then it went back to 70. And it did that a few times. So it was a very, very hard hold. What kept me in place, aside from a bit of stubbornness, the previous management team just did not execute well. They got over their skis. They had zero cost discipline. They were trying to take over the world. They were also a function of the market of the day, which was, we don't care about anything except revenue growth, and here's as much free capital as you want, right? So that was kind of the setting. And despite all of that, though, one thing you can say about Catapult was was in a very exciting market. I mean, if anyone watched Moneyball or read the book, I'd recommend it if you haven't. But it just shows you how, professional elite sports is big business. And we really aren't that far past the days of the clipboard and the stopwatch, and the whistle. and it always felt odd that tech wasn't more penetrated into this space. And so Catapult had this really cool tech developed from the Australian Institute of Sport, was being adopted by some really amazing tier one teams here and abroad. And it just the top line growth was consistently around 20% year after year after year. I'm talking about the core product. It's had a number of naming iterations and whatnot.
And also I just wanted for the nerds in there. So originally it was like a mixture of like a capital sales and more of a subscription model, but yes. I think I'm correct in saying that they sort of switched that to I think almost 100% subscription
full
model,
subscription.
if I'm wrong. Yeah, so they switched that, and that's something to look out for. I'm pretty sure that play might have been pretty much died out by now, but one of the most repeatable things you saw is total revenues would sort of plateau as companies transition from more of a one-off sales process to a subscription sales model. So one company I own that is probably at the tail end of this process right now is RPM Global, is another example of it. RPM Global.
It's totally something to look out for because the revenue just takes a massive hit, right? It's just sort of we've been selling with the price at the outset, all up front, captures everything. And then you're spreading that over the lifetime of the contract. So obviously revenue takes a big hit. The reason that you do it is that the visibility of revenues goes way up and you get that lock-in as well. So it's sort of on an amortized net present value basis.
It's always
better.
Worth it. That I don't think I've never seen a company where that's not worth it. It's worth it for three reasons that I can think of. First of all, maybe not so as true for Catapult because there's a hardware element to their thing, but certainly for a pure software product, which Catapult has some of anyway, a subscription crowd product makes way more sense because if they're paying a subscription, then you're automatically incentivized to increase value wherever you can because that will improve retention. Whereas if you've just made a one-off sale and whatever new developments you could do, you're not incentivized to go back and try and improve the product they're using. What you might do is be like, hey, we've got an upgrade. We're trying to upgrade you, blah, blah, blah. It's a whole new sales process. It just doesn't work as well. And so actually one good thing that people never talk about is that having a subscription product has taken off really well because it does tend to align incentives between the company and the customer better. But then secondly from that, usually with subscription prices, because people paying it bit by bit, you can actually charge a higher price. So you often see when people make this transition, there's an uplift and an uplift in LTV or whatever it may be, or how not just LTV, but the amount they can charge per year, sometimes anyway. And then the last one is just the market. Humans like certainty. We pay more for certainty. You got more visible, understandable certain revenues. Hey presto, you got a higher multiple. Anyway, take us back. So can I just situate us back in Catapult now? Because you told us a bit of the story, but if you look at Growth Gage's article, I love how he included two charts, one longer term and one shorter term. Did you look at that article, by the way? You see the charts there? Yeah. So you see how he's got the chart about all of the things that happen to it, like listed, acquires, player tech at raises capital at $3 a share, then $2 a share, and then so Joe Powell, not the most successful tenure as CEO there. You can see where he came in and where he left. And then Will Lopez took over. It kind of went sideways for a while when Growth Gage started getting, very enthusiastic about it. The share price hadn't moved too much, which I believe you were buying around that time as well. But then since then, the second chart he shows is just results showing better free cash flow included in the tech index, more free cash flow and actual evidence of operating leverage in the half-year result, included in the ASX 300, than in the most recent result that we've just seen, a few days ago. basically the biggest key takeaway that he wanted to highlight on his chart, which I agree with, is better free cash flow, at least as he defines it, and also most importantly, continued operating leverage, because it's that continued, the fact that, the loss, when they earn more revenue, a lot of that's falling down to the bottom line now. That is what is driving the share price, because finally, after all these years, you're actually getting, this is the best evidence you can have that this will become profitable.
Yep. So Will, it's worth remembering that Will came in 2019. So this has been a 5-year turnaround. And it's sort of like, okay, at this point, everyone gets it. But it wasn't that long ago where there was plenty of doubters and plenty of skepticism. And I'm not even trying to sort of say, oh, that was really dumb. I absolutely get it. The ASX is full of gunner companies that, oh, we're going to do this and we've said this, and they just never do, right? They just never goes to plan. And so even though management are sort of beating the table saying, hey, listen, this is what we're going to do, this is what we're expecting, no one buys it, because it's sort of like, I've heard this song before, right? It's just like, I'll believe it when I see it. So it's worth putting that in mind, because these things always look easy in hindsight. But this was, yes, good tech, yes, good sales traction, woeful mismanagement. And then Will comes in and says, okay, we need to right size this. We need to change the subscription model. We need to stop the bloat. We need to focus back on our core areas. And it took 4 and a bit years for that to happen, right? And it's just like, for us in investor land, that is forever. But anyone who's run a business, and like even before the recent jump in its market cap, this was a large-ish business, hundreds of millions of dollars in market cap. I know that's small on the ASX, but like, again, I would try to get listeners out there to put yourself in the shoes of a CEO running a company of that size with however many umpteen hundred employees and making very hard decisions and turning that around. It just takes a long time for new systems and processes and morale and culture. And, it just takes so
it's
long.
Patience.
You've got to give them enough rope. Yeah, you got to give them enough rope.
I have to jump in because what you just said spawned like 3 different thoughts for me. First of all, like, you get straight to the core of how you and I are different as investors, which is like, you have the patience to wait through all this. That is the difference. Or that's one of the key differences anyway. And secondly, from that,
just on that though, it doesn't always work out. Like I have had patience up to a point for things like EnviroSuite and Pointera. They didn't work out too well, right? So it's not. I've got to be careful not to paint this as a good thing. Not always.
Yeah, I'm not saying that you always have infinite patience or anything. It's just more than me, like I situate you're one of the investors that I've followed closely and talked with and understood the best. Like, I've probably known your portfolio like close to consistently for like 10 years now, right? Like, how many people actually know each other's portfolios for 10 years? For any listener, tell me in the comments, like, how many other people's portfolios have you actually been to track exactly what they're doing for 10 years? Because the old adage being, a dumb man doesn't learn, or a smart man or woman, learns from their own experiences, but like a wise man or woman, like, learns from the experience of other people. Well, it's quite hard to do with investing, because it's not that many people who'll tell you constantly like exactly what they're doing and what they're holding and stuff like that. And so it's hard to learn from other people when you're only ever getting snippets of it. And of course, everybody has an incentive to just tell you about the wins and not the losses. Or
totally. And it's go for it. Sorry.
Oh no, just another thought you spawned, which I just have to put out there, because no one else would know this but me. But not no one else, but no one else would remember this than me. But like, you wrote what I think is singularly the finest article that I've ever seen. On November 26th, 2014, you were published in the Sydney Morning Herald. The title of the article, Motley Fool, one gunner company that can. And when you said about gunner companies, that's what triggered that memory. Anyway, that one gunner company.
Was that 2014?
Dude, I wish it was me that wrote that article. Like, I'm so frustrated.
Can you send
about
it through? Actually, I forgot about that.
Yeah, it's one gunner company that can. It's on Sydney
Right.
Morning. It went through Fairfax, so you like reached a lot of people, and that's why like I feel when I had the opportunity to write those articles in Fairfax, I'm ashamed I never did one on Pro Medicus. But that one was on Pro Medicus when it genuinely we had like literally bought it like not that long before. That was
Huh.
like November 2014. Like that is in terms of what appeared to the most number that in terms of the good you did to people, the good you put out into the world, that is probably the finest article that I ever know of.
Well, thank you, sir.
And yeah,
Thank you.
like I always wish that it was me that did it.
I'll
But
have to look at that now.
2014, November 26th, 2014, man. Like, look, it's
Yes.
obscure knowledge, but I guess 10 years later, you're just reduced to like being like, oh yeah, back then we were real good, weren't we, mate? Yeah. Catapult. All right, back into the story of Catapult. Okay, so at a certain point in Catapult, you had me in your ear being like, yeah, man, this company's all promise, no deliver. They keep on like raising capital at lower prices. What is it that made you stick with the stock, even though there were some criticisms that people could have made, which I made to your
Do you
face?
know? Do you know? This is going to sound really simplistic and dumb, but I mean, if any business is going to succeed, whether it's the corner shop or whether it's some massive multi-billion-dollar multinational company, ultimately, you've got to have a good product. Like, I feel dumb just saying that out loud. Catapult had great tech. They had really good tech, and you could tell they had good tech because it was being used with customers where the stakes couldn't be higher. And it's one thing to trick a customer into using your product, but you don't have 95% plus retention for players like, well, customers like this, for a bad product. They were a first mover in a very large, lucrative, acyclical market, and their customers were happy to stick with them, and they were winning new customers every year. It was just that it was a matter of that simple. Now, okay, management weren't executing well, and there was no cost discipline. But when Will stepped in, he articulated the problem. He very much identified what it was. He put forward a strategy to rectify it. And again, it's turning the Titanic. So, I think a lot of investors go, oh, he's been there for a year and nothing's happened yet. And again, I would just try to encourage you to think for yourself how hard that would be.
For any listeners there, a lot of investors that's me. Yeah.
It's hard, right? 5 years feels like forever, but it's kind of not that long. And so not only was the core product good, not only did the new CEO realize what the problem was and have a good plan, but it wasn't an instant fix. But you could see the progress that was being made. Nature was healing on it, right?
Honestly,
And
man, where I come from, it is like if I didn't make a dollar out of it, like I'm at least happy people I like did, basically.
yeah, and look, I'd actually, it's interesting now because I've gotten a lot of attention on it, but I actually think it's overvalued according to my analysis. Now
Well,
yeah,
Mr. Growth Gauge has he is also starting to worry about valuation if you read his article as well. So I think
well, so but I have learned from Pro Medicus, speaking of Pro Medicus, and this is,
exactly.
I've got to be careful what I say here because people hear what they want, and I'm not about to say don't worry about valuation. Worry about valuation, right? But don't overthink valuation in the situation that the business is super sticky, super high growth, market leading. You want, and has a lot of optionality, which Catapult definitely does, and which Pro Medicus definitely did as well. So it's kind of like, yeah, it's a little hot, that share price, but winners tend to keep on winning, and I don't want to overthink it.
It's also a hot market now. Like we're finally getting some flows back into small caps. But something that other wise monkey once told me, and I don't know if he was serious or flippant. I'm pretty sure he was flippant. I don't know. Either way, the point is that it stuck in my mind as he said, "Yeah, never sell a multi-bagger," and such a simplistic rule. Never, obviously, never say never. I'm not saying he was serious about it, and I can't remember the context in which it was, but he was a flippant remark, but it really stuck in my mind. And I think there's some truth to it in a way, in that it's not a terrible rule of thumb or starting position. Because usually if something's rocketed like this, and if something has, look, you gave us a lot there. Like for It's a good reminder for everybody, including myself. Like one of the biggest signals you can have is just this product is better than everyone else, and then that shows up in high retention rates. That shows up in selling costs are less.
Yep.
That like as in word of mouth is always the best way to sell.
It's
Right?
easier to
People want
sell
your
when
product.
someone calls you. Yeah.
Yeah,
And you're not cold
exactly. So
calling
like
them.
having the best product, like the truly best product in a field, and also I don't even know if Catapult does, but a lot of people I admire think that if it doesn't have the best product, it is definitely still good. Do you know what I mean?
Yeah. Yeah.
As in like it has minimal competition is the kind of language that I hear around it
That
from a
sports is
lot of
probably the
people I
biggest
admire.
competitor. Yeah. Yeah.
Yeah,
And they
yeah,
don't have the same
exactly.
full stack.
That's
And
comes. Yeah,
yeah.
it does seem like
People,
it's a possible leader.
I've always thought people overestimate the impact of competition. Like virtually every company has competition, and it's not like it's fine to have competition. And it's actually in markets that are very large and are themselves growing. It's kind of like it's not even it's just not something to worry about. You start worrying about it when the other competition has demonstrably and significantly better product, and they are seeing significantly better growth rates, because you can just push all of those things forward and go, well, this is not leading to a good space. But healthy competition between 2 or 3 top tier companies, I don't worry about too much, and I think Stat Sports has probably got a lot of potential as well. So yeah, I just make that point, because it's always interesting to me when you see investors go, oh, but there's someone else out here doing this. Like, yeah, like, what do you think, you're investing in a monopoly? Like, of course there is. So keep an eye on it, but don't freak out about every time you notice that there's someone else doing something.
Except through like regulation, it's
Yes.
very well. You could even say always regulation is required to have a monopoly, because every government has the ability to legislate against a company that has managed to get itself a monopoly
Yep.
without it being regulated. So really, ultimately, if a monopoly exists, it's ultimately a political thing. You can either have it granted to you, or you can get it and then pay the bribe and pay and cajole politicians into letting you keep it.
Regulatory capture is such a big thing.
Yeah,
I
but
could
one way
rant
or
to you
another,
about
like
that for a long
monopolies
time.
ultimately come down. Well, there's always regulatory risk in a monopoly, is I guess what I'm trying to say anyway. So
Yeah.
actually, maybe the ideal situation is just being like competing and beating everyone fairly. Like that's the ideal situation. But
And not in a stagnant market, right? Like, so yeah, like Coles and Woolies are battling over. They are already dominant. Anytime Coles wins, it's because Woolies loses, and vice versa, right? Like that's hard, and the market itself is growing, 3, 4, 5% tops, sort of thing. Very different when you're in an industry like Catapult is, advanced, sports analytics kind of company, where the market is not only massive and untapped, because Catapult's by far the largest and they've got a lot of market share left to go, but the market itself is growing. It's just so different. Like you don't want this, but mathematically you can be in a situation where you're losing market share and still growing, like when the industry itself is growing. So it's just a nice tailwind to have.
anyway, I also want to do, because I'm a big one for actual shout outs of people who have contributed a lot to understanding a stock amongst the community of individual investors. Because, like, actually, now we've lost into it quite a while ago. We still need to find a place for this to exist again. So I want to give a shout out to Andrew Brown, who, besides you, is the number one person who's like added the most to the public sphere of like, individual investors about Catapult. And one of the angles that I think he brought in, that was useful, was that just how much money is getting pumped into these big elite sports now, or at least some of them. And this is a key insight that should have been the aha moment where I bought back in. That's when it should have been the time. And he was saying that when it was $1 something or $2 something or anything, it would have been an easy double if I'd done that. And the reason that is such an important point is because if you're an expense of somebody, you want that somebody to be like having a lot of money themselves and having a lot of demand. You want their business to be healthy, right?
You want your expense to be a small fraction of what you're otherwise spending. In other words, imagine you're An NFL team. I don't know my NFL very well. You're a very famous, well-regarded NFL team.
English Premier League's the
Right,
best example.
even better example, right? Like, so what do they spend on acquiring a player? Like, how many hundreds of millions? Like, it's insane, right? It's so many gazillion dollars that when Catapult rocks up and says, "Hey, you have just invested umpteen hundreds of millions in your asset base, your players, and you could spend, $30,000 to get the best out of those assets." It's a no-brainer. Like they would spend more at their Christmas party than they would on their Catapult tech stack. It's such a no-brainer, right?
Can I say something though? This is what Andrew Brown said to me. He said there is a hose of money because of the growth in sports rights and the relevant sports that the technology of Catapult can be applied to.
Data is super powerful. I don't know if anyone needs to get this memo in 2025, but data is really, really a big deal, right? And there's a whole bunch of reason that Silicon Valley companies are giving you all these services for quote unquote for free. You're just paying for it in data because it's super valuable. And when you've got the data, as Catapult does, you're like, okay, yes, disaggregated in a lot of ways and there's a whole thing we could get into there. But the point is like, that seems to me like something you could build an app around. That seems to me like something that fantasy football enthusiasts might be interested in. That sounds like something that broadcasters especially in the era of smart TV and smart broadcasting, where fans can sit around and go, I want to see this and I want to do that. We haven't even scratched the surface of that yet.
They had that broadcast angle ages ago, and maybe they still do, but I remember at some point they used to come up with, like, in the rugby league games, like with how far people would run or something like that.
Kindergarten stuff.
I think one of the reasons I missed this one is because I'm a nerd, I guess. It's kind of arbitrary, and I totally did sport throughout high school and gave it my all. But ultimately, I'm just not much of a sports fanatic or whatever. If someone says, "Hey, you want to go to a game or whatever," I'll be there and I'll get into it. But just to the degree that a lot of people love it.
I was just going to make another point on. I wrote about this recently because it's just been on my mind a lot. Is that this idea with investing? Again, this probably is going to sound obvious as I say it out aloud, but what really matters to you as a capital allocator is the average. I mean, right? Like, what do you care about? You care about your portfolio. That is the only thing that matters. And I've been thinking a lot about David Gardner recently. And David Gardner is the co-founder of the Motley Fool. I'm not here to shill for the Fool. It's got nothing to do with the Fool. That just happens to be who he is. But
David Gardner is an extremely interesting investor and teacher. That's why he's the one you're bringing up, no doubt. I have no idea what you're going to say, but he has.
What's interesting about the TLDR here is that David's strike rate sucks. His average is insane. In other words, his portfolio has grown to compounded at ridiculous rates over very long periods of time. But something like only 3 out of 10, 4 out of 10 of his picks work out. The rest bomb, and I don't even just underperform the index. Some of them have gone terrible, and I want to make that point in regard to Catapult because it's gonna. I'm not trying to be falsely modest here as well. It's really great. Catapult's worked out. I'm very happy for it. But a lot of the things I saw in that I have seen in others and that haven't played out as well. And so it's very easy and I think very right for people to go, well, isn't it interesting? A couple of finance bros talking about the one that worked out. What about this? What about that? And I actually want to drill into that because I think, and it depends on who you are as an investor and your style is, but I'm becoming more like Dave, or trying to become more like David as the longer I invest, because what took a while for the penny to drop, but now that it's dropped, I'm very religiously a believer in, is that if you swing for the fences, you're going to miss a lot. But those ones are probably only going, worst case scenario, down 50, 60%. If you get it really bad, you might lose the lot. But if you get it right, you get 10x or 100x. You actually get those numbers. And when you start doing the maths, you only need to be right 3 times out of 10. And your returns are insane. And
I'm going to agree with your point as regards to David Gardner in terms of there's a lesson there. And I agree with it. I also, like you, I take that view. But I want to still stress it doesn't always work because his brother, Tom, who's got a similarly timed track record, and also is very similarly never sell minded, doesn't have the same track record of success.
Yes. Yes, you're right. And I reckon the difference is that you definitely want to be patient. You definitely want to give management enough rope, but you don't want to give them too much rope. So when a thesis is busted, clearly busted, objectively busted, not just it's taking longer than I thought, just like it's just totally not working out, you got to walk away, right? I really think that that's the case. Also, when it's going well, as we were speaking about with Pro Medicus, is that you've got to let your winners run. If you're going to be the kind of person that does this approach and then you quote unquote take profits or lock in a profit, and so you never go broke taking a profit, and you're going to like lock in every time it doubles, the maths breaks very, very quickly here. So you've got to allow the winners and understand that they're going to be the exception to the rule. But the winning is really evident over a 5 to 10 year kind of period. It's not about getting a little bit of a pop, because that pop's not enough to account for the losses.
We're all victims of our circumstances. We're all victims of our circumstances. But like the thing that's like changed my life is like getting huge winners and just like holding them.
And just holding them, right? And that's what I didn't do with Pro Medicus to the degree I should have.
The less you sell, the better. There's any massive winner is inevitably going to. I'm the same with Catapult though, man. Like, and there's many others. Like some, everyone does things right and wrong, and we're all victims. I'm super the victim of the circumstance of having like a few very big winners, kind of thing, and I don't even know, like I haven't fully analyzed every single trade I've ever done, but I have fully analyzed like my buy and sell recommendations. And the only reason that sell recommendations add value that I've done in my career is because if you assumed that capital was then put into subsequent buy recommendations. If you compare it against say the market, a lot of things that I've said a sell on have gone on to beat the market. But what they haven't beat is the sort of buy recommendations that I personally put the capital into. But it depends what you're comparing against. They're different things. But I think sells help optimize my portfolio. But if you're just measuring it, there's very questionable arguments about how much value sells are even adding, kind of thing. And I have very philosophical questions about it to myself of like, what should I do as a person and as a person that gives advice? Like, what should I?
Yep.
Anyway, Look, is Catapult a small cap? Debatable. This is the small cap wrap.
I'll give you a small cap. Well, I'll start off by saying that most of the people on Strawman hate it. And most of the people on Strawman are very smart. So, take that for what it's worth, and I think it's worth a lot. And so, but there's two reasons I raise it. One is because he said, I think of a stock that maybe a lot of people aren't talking about. Two, it has potential similarities to Catapult from a few years ago. So for those that don't know it, it's basically a sensing company. They have a bit of tech that they developed in-house, which basically uses fiber optic cable to detect perimeter breaches. It's really cool tech. It's actually widely deployed and used in a lot of different ways, but their secret sauce is in the algorithms that sort of does all the physics-based calculations to work out did a frog just jump over, or is there someone actually trying to break your perimeter there? And they've also got some access and illumination businesses as well, but it's all about protecting perimeters. Anyway,
what's the Illuminate business? So the other stuff's security.
So they acquired that. It's a UK business, and it basically, like when a perimeter is breached, there'll be floodlights that come on, cameras that show you what's happening.
It's kind of an add-on because So they already had a certain kind of sensors, and they bought a business that had different kinds of sensors to add to their sensor kit.
Arguably, they shouldn't have done it. Would be I'm very familiar with companies that have got really cool core tech and decided to grow themselves broke by getting into all these adjacencies that just didn't work out. And it's probably too early to say that about Illuminate, but EnviroSuite comes to mind as some of the dumb moves that they made, et cetera, despite their core tech continuing to grow at 20% compound very long. Anyway, so the thing that it's interesting about it was that, like Catapult, they have some cool tech. They've had some good traction. but it wasn't managed particularly well. A new CEO, Mal McGuinness, came in just a little over 2 years ago, and he's like, right, we've got to completely reinvigorate the organizational structure, the product offering, the go-to-market strategy. And it's taken him about 2 years to do that. And so, as I said before, it took Will Lopes at Catapult 4 to 5 years, depending on when you want to sort of measure the point of inflection. And I think with Ava, people are very skeptical about it because they put out some pretty bold forecasts which have fallen short. Now, the company's continued to grow at the top line. Most recent half, it swung to EBITDA positive. They got about $5 million cash in the bank. But they're chasing these very big businesses with very long sales cycles, long integrations. It's just hard to do. And I'll give you a sense of the changes that were made. He said to me just this morning that when you exclude the manufacturing team and you just look at the other part of the business, out of 40 to 45 people, they changed 30, which you can imagine working at a company like that where there's been such massive wholesale changes, what that does for morale and the rest of it, arguably needed to be done. But it's interesting because everyone hates it. It's dirt cheap. It's 10 cents a share on a company that's doing, I've gone blank now, but should be somewhere in the vicinity of 40
so
odd
$17
million.
million. So 17,
Yeah.
good guess, man. 17
for
million in
the
the
first
last
half.
half.
Yeah. That was 20% growth, I think, too, in revenue.
Yeah, so it could be a little under 40, or I don't know, but it's not that ridiculous.
It's very. Here's the other thing as well. And he said he stressed this morning. I mean, this is lumpy, right? You're dealing with big businesses. There's all these sort of like $100,000 to $300,000 contracts dribbling in all the time, and every now and again you get this big monster one that sort of comes through. Oh, it's just not an even Steven kind of thing. So again, like market spreadsheet jockeys, they just miss this stuff. It's like, oh, it didn't grow on this half, and it's all a disaster. It's all over. It's like, no. Again, forget the share market. Put yourself into the position of this business. They're trying to sell these big integrations to companies like Honeywell, companies like UGL, companies like Telstra. Like they are slow-moving companies, right? And you're not going to win a massive contract like clockwork.
We need to write an article about this one just because it's basically at break even from the looks of it.
So it's at this inflection point, right?
Exactly.
Cost base has been fixed.
I don't even know.
He's again said that the cost base is right. The team is right. They're winning the contracts. They've had people like Telstra that go through these massive trials that very rigorous. And they come out and they win. So they're getting more and more reference sites. It's just, look, they're on their last straw with me. I should be 100% clear. Everyone else on straw, well, not everyone, but a sizable number of people on Strawman are like, Andrew, you're being lulled in by very lofty aspirational targets here. They've said this for a while. They've revised it down. They haven't delivered. Yes, it's super cheap if what they say is going to happen. But why would you believe that? Because they've consistently fallen short, which is a really, really good point, and I really, really need to highlight it. The only reason I'm sticking with it for now, and I'm raising it here, not for people to run out and buy it, but to do their own analysis, is that it strikes me as, again, a company that actually has a good product, that actually has a good market opportunity, an extremely fragmented market in a world which is becoming more and more security obsessed and more dangerous.
Exactly.
And it feels like a couple of wins. If we do, let's revisit this in another year or two, and there's two possibilities. They're continually saying stuff that ain't coming through, and it's probably going to go from 10 cents back to 7 or 6 cents. We could lose 30, 40%. But if they start delivering on some of these things, this is a 30, 40 cent stock in a year or two, right? It's sort of like I'm very, very interested in any kind of investment where there is massive asymmetry. It's like, I'm going to get it wrong.
So by the way, disclosure. I'm assuming you own shares in this still, which you have for
Catapult and Ava of what we've mentioned, and XRF, if we mention that too, I own that as well.
We're doing Andrew shares today because we've got the honor.
Relative to my largest position, they're all rounding errors because let's not talk about the shiny orange money token.
You guys know what his largest one is.
It's hard not to be when it's 5x, but anyway.
He likes his Bitcoin for any new listeners. That's his faith. But anyway, there aren't many Andrew stocks, but I'm glad we're covering off on them. And look, mate, thanks for doing Ava right now, because I actually think it's an interesting time to look at it. just because the H1 results were looking a lot closer to break even. So obviously there's potential room for a narrative change if the company starts getting profitable. Then it's
Big if though. I really want to hammer that. Okay, like I don't want anyone adding me in a year's time.
Look,
you know,
look at how far Catapult's gone, and it still hasn't made a statutory profit. You know,
right. You know,
so
this we invest in a world of narratives.
I'm not saying, by the way, I'm not saying Ava Group is as good as Catapult or it should be like compared to it. But I'm just saying that,
wouldn't it be great if it was? But yeah.
I just
but
use it as
my
an
point is,
example.
I guess I would want to tie this all together because I think it is that I'm not saying that this is a setup that's a slam dunk. Like it's not. There's no such thing. Except for Bitcoin. but my point is that if you find 10 things that fit that mold, right? Fit that broad mold, you're going to get them wrong a lot. But when you get the Catapult that goes from like the 50 cents to the $5, when you get the Pro Medicus that goes from the 90 cents to God knows whatever bloody price it's at now, you know, or when you potentially get the Ava that goes from 10 cents to 50 cents, that's the ones that you've got to look out for. In aggregate, you'll probably do okay on that. And so I raise it not as a slam dunk, but as one that potentially fits that mold. So if you're going to go out and allocate 100% to this thing, you're an idiot. But if you're going to do 10 of these kinds of things, I would posit that probably over a 5-10 year period, you'll do pretty well. And even the ones that, and this is the one more point I should make on Catapult, even when it does work out, it doesn't work out in a straight line. You're going to have many 50% drawdowns along the way, certainly 20% drawdowns, right? So
look, man,
you've got to own game. I understand that.
I even wonder how many people still do the whole small cap investing thing. Like, it's got to be. It's not the biggest community in Australia, is it?
Nah, people love to say they do.
Well, like, I don't think the younger generations are necessarily doing it at the same rates, right? Like, because there's a lot of other things they might be interested in. To like, you know, crypto was never a thing when I was like 22 and being like,
I don't invest.
You know, what should I do with my money?
Screw that.
I know you don't. I know you don't. No, I'm not saying about you. I'm just saying
it's all a scam except for one.
What competes for the attention of stocks? So small cap. When I was like 22, you know, ASX small cap stocks seemed like a more obvious potential place of mispricings. But now, and back in those days, it was actually genuinely administratively harder to trade US shares, for example. Whereas now that's all very easy. Crypto's very easy. There's like a bunch of stuff.
Crypto. You're going to trigger me, man.
Yeah, sorry.
Trigger me.
Okay, I'm sorry. Look, okay. Well, anyway, look. Okay, the final bit of news today is because this is an ASX Small Cap Wrap. I'm just going to chuck out the news. The reason that I was going to mention XRF today, was basically because I know Andrew knows a little bit about it, and also because I saw today that one of the directors, who's actually a managing director, Vance Stazzanelli, he bought $16,000 worth of shares, which is hardly a large amount of shares. But hey, it's better buying than selling. And then the other thing is that another director, David Brown, he bought $56,000 worth of shares back in March as well. So at sort of, I think, vaguely similar prices to what we are now. So, you know, I own that one, by the way. Me and Andrew both own XRF.
Yep.
But to see a profitable little stock, it pays a dividend. It's a couple of directors have put in a little bit of money recently, and also it got added to the ASX All Ordinaries recently as well. So look, to me, usually, so yeah, I've owned it for a while. It's been a good investment for me. I haven't owned it for as long as some.
I got in at 2020, start of 2020, so about 5 years.
This one is one that Strawman did really well on, right? Like Strawman had it pretty early.
Yep,
from memory.
Shout out to Luke Winchester here. He put it on the radar, and he picked it. What I always give extra credit to Luke on this one. It's always nice when a share you like goes well, but it's kind of like, it doesn't count unless it goes well for the reasons you thought it would go well, right? Like, it's hard to do a victory lap. It's like, I'm buying this because of X, Y, and Z. It's like, it goes well, but for entirely different reasons that you thought, right? So that's just luck. And what Luke identified back in the day was it's a company that had come out of a heavy investment cycle. So all this CapEx, all this money out the door and nothing to show for it, which anyone who's run a business knows that's how it goes, right? You spend money, you make investments, and then you hope that you get a return on it. But the market, which is so myopically focused on the here and now and cash flows and this and that, is like, free cash flow is down. What's going on? The business is in trouble. With the more important question is, what did they spend the money on, and what's the likelihood of success that they'll get a decent return on that? You also had a situation too where there was some sales cycles in terms of the capital replacement cycle was coming through, and it just all lined up. But the bigger story here with XRF is that it's a very quiet achiever where you've got a very aligned, long-term focused management team. They are no nonsense. I've spoken to Vance a number of times with Strawman. He is always very level-headed. He's not out there hyping. He's very grounded. He's thinking 3-5 years out. And the numbers just show it. I mean, you can bring up whatever your preferred platform is and just look at the earnings per share, look at the return on equity, look at the revenue. It is up and it is to the right. And if people like,
yeah, no, it's good. We haven't even said what it does. So, like, I guess this podcast is kind of pitched at a pretty niche group of people. So, rest in peace, like, virality. But, yeah,
they do.
Look,
they do
I just
genes and reagents to test for quality and purity of mine samples, essentially. And
so they're testing. They're in the business of testing mining samples, but also making the machines that test. They don't test it. They make the machines.
Razor and blade, baby. Razor and blade. Yeah,
it's testing. They're also crushing. Blah blah blah. The whole process, essentially. Even the equipment people use, etc. That's the business they're in. They're supporting people who need to test samples. That's what.
And you know what? You know who needs to test samples? Here's the thing. Mining is a very cyclical business, a very capital intensive business. But if you're in business, full stop, if you're out there and you've got operations, you need to do this stuff. This is not a nice to have. I wonder if we should test for purity. I wonder if we should test for concentrate light. No, you have to do it. You must absolutely have to do it. And you can do it directly yourself on site, or you can farm it out to someone else. But this kind of stuff, this is the pick and shovel kind of play, in the sense that if you believe that there will be mining continuing in the future, and yes, it'll be up and down and commodity prices will move all over the place, these guys should just be a fairly quiet achiever in the background. Yes, there will be capital replacement cycles, so some of these sales will be a little bit lumpy. But also the other component, which I touched on, which is the razor and blade model, they make the reagents for these machines, which are very high margin, which are just another way of basically saying high margin recurring revenue component to it, which is going to like sort of pay the bills during the more leaner times. And so I like the stock.
Awesome. All right. Well, let's leave it there, mate. That was a great synopsis. For anyone that wants to read more about Catapult or XRF, you can look up XRF reports or Catapult reports and A Rich Life. There's a handful of free articles on both companies. Ava Group, I don't think we have much that's not out of date, but that's an interesting area for further research. So thanks for sharing that with us, Andrew. And look, it's so wonderful to catch up with you, my friend. I hope you have a lovely afternoon and evening. And thanks for listening, everyone. Please do the like, share, subscribe, blah, blah, blah. You know the story. Love any fucking reviews. It's just wonderful. But yeah, basically, most of all, thanks for being part of the small cap investing, community now, because it's really sustained me throughout my life, and I have a lot of appreciation for it.
Yeah, share the love. It's great to be part of it with you, man. Part of the journey. So yeah, let's keep on trucking.
All right, thanks for listening, everyone. Bye.
Bye.